So, ladies and gentlemen, when you went to high school, of course, first year of high school, if you're in a very bad high school like the one that I was, Nanyuki High School, right? The first year, the whole year, we were really kind of what year, being beaten left, right, and center, because they were calling us what year? Mono. So mkaenda form 2. Form 2 mkaitwa namna gani? Nani alienda kwa shule mbaya kama yangu? Form 2 mkaitwa namna gani? Form 2 mkaitwa namna gani? Form 2 mkaitwa namna gani? Ama yenu haikuwa kuitana majina? Yenu haikuwa na kuitana majina, eh? Right. So ukisikia jina binary, bi means what here? 2. Bi means 2. 2 possibilities. So basically binary options are options with 2 possible future prizes. 2 possible future prizes. 2 possible future prizes. So for us to be able to appreciate what Mwalimu is talking about this afternoon, I would want, ladies and gentlemen, to give you an example. In this example, they have given us the stock price, the current stock price, call it current. The current stock price is 100 Kenya shillings. Right? Exercisable, or rather, talk of exercise price after 1 year. After 1 year will be 110. 110. And then they have given us the risk-free. They have given us the risk-free rate. The risk-free rate is 5%. Risk-free rate is 5%, right? And then they have given us what we call the U. The U in this case here is 1.2. The U is 1.2. And then we have the D. The D is what here? Is 0.9. So U basically stands for upward. Stock price index. Upward. Stock price index. That is U. And then B stands for downward. Downward stock price index, like that. Index. And then we are required to calculate the current value of a call option. Calculate the current value of a call option. Current value of a call option. Once you finish writing, could you kindly put up your thumbs up, or simply mention there Y for yes. Simply mention Y for yes. Simply mention there Y for yes. Y for yes. Simply mention there Y for yes. Y for yes. So binary options are options with 2 possible future prizes. Only 2, because binary means 2. Jemima says yes. Jemima says yes. Now, ladies and gentlemen, this semester, if this examiner shall bring you a question of options, this is what he shall do. And I'm so sure with this, he'll be able to knock off students, or rather knock students off their feet. Because I know with this kind of information, now that they have used here the word call option, students will try getting the value of D1, getting the value of D2, etc. So, for instance, for the students who watch the videos, is there somebody who is able to remember the formula of D1? Could you kindly try to remind yourselves? D1 equals who in the numerator? D1 in the numerator, just try to remind yourselves, D1 equals who? At least there is something that you must remember. There must be something that you must be remembering. There must be something that you must be remembering. You can't have watched those videos very early in the morning and then you tell me that, Mwalimu, I can't remember that there is an ln. There is an ln somewhere. There is an ln somewhere, isn't it? Yeah, P over E, thanks Dex. So we have here P over E, thank you so much, plus into brackets. What do we have inside brackets here? What do we have inside brackets? The very first thing inside brackets here will be, we shall overcome. The first thing should be what here somebody said by bracket. There must be an R. And then we have a variance over 2 times time, all over standard deviation, square root of t. This is the first thing that they will think about. This is the first thing that these guys here will think about. Because they want me to value a call option, let me use the Black Scholes option pricing model. So great. So they start smiling in an exam. They start smiling seriously in an exam. But now when they start looking for figures, for example, if it's risk-free, they are able to see risk-free. They're able to see the current stock price, which is P. They're able to see the exercise price here. It's given. But now what do you do? Of course, even time after 1 year, they're able to see that. But now what do you do with standard deviation? Is standard deviation given here? In this question, do we have standard deviation? Or do we start calculating it ourselves? What will you do? So again, the mood swings. The mood of students in this case here now goes from this. It goes now from this. You know, they have been smiling. Let me draw up here. It goes from this to this emoji. The standard deviation is not given. What do you do in an exam? So that automatically means that this entire question will get a 0. If I get a question in an exam where they haven't given me standard deviation, always I'll think about binary options. If standard deviation is not given expressly, okay, if they give me variance, of course I know you guys also appreciate the fact that if you're given variance, you can easily, in this case here, change it to what here? To standard deviation. Who can remind me the formula? If, for example, I'm given a variance, how do I change this to standard deviation? If I'm given a variance, how do I change it to standard deviation? Square root. Thank you very much, Atieno. How I wish. Today was an end month. It was end month when we have good money. I would have done something immediately. Square root. Thank you so much. Square root. Thank you so much. Square root. So if I go to an exam, realize that they have given me variance. Variance is as good as what your standard deviation. Variance is as good as standard deviation. So if standard deviation is given, then automatically I'll not have a problem with Black Scholes model. But what if standard deviation is not given, variance is not given, then my mind should always fly to what we call the binary options. And if it's binary options, I'm going to draw a probability tree. And this is how my probability tree will start to look like. So the SO in this case here will be 100. SO, O means today, current price. O means today, which is the current what here? Current price. Now, today's price is 100. In the future, 2 possibilities. So in the future, 2 possibilities. So we have in this case here S upward and S downward. S upward and S downward. S upward, and S downward. So, ladies and gentlemen, S upward, they have given us the upward index. You take the index and multiply it with this. So it will be 100 times 1.2. So the stock price, if things are looking north, will be 120. And then we have S down. This one here will be 100 times 0.9, which gives me 90, like that. We have to put this in boxes, like that. Put them in boxes, like that. Okay, thank you so much. So far, I've not done anything, any damage really. I've been able to get the upward stock price and the downward stock price. That's what I've done. Nothing more, nothing less. Now from there, we go to the next step. The next step now is all about getting the value of options. The value of options. So remember, value of an option basically is the profit of an option, the profit of an option. Value or profit of an option. I should write this in a better way that you guys will be able to see. This should be value or profit of an option, or profit of an option. So that it means that I need an exercise price. Have they given me the exercise price in this question? Have they given me an exercise price in this question? Have they given me an exercise price in this question? How much? 110. Thank you very much. Excess price is 110. Excess price there is 110. Listen, if you understand this, actually you don't even need to stay in today's class. If you understand this, we simply close the class and allow you guys to go and watch the videos. This one is the most important thing. Catherine, there is a question you have written down. Is it possible somebody to take a snapshot of that question, send it in a WhatsApp for Catherine also to benefit? She came in a bit late. Now, so what will happen, ladies and gentlemen, here? I would want to hear from you. I would want to get the call if there is an upward trend. The call value if there is an upward trend. So what will happen here is that they have given me a chance of buying this option for 110. If I exercise, I'm going to buy it for 110 Kenya shillings. And then, of course, the same option will be able to fetch how much in the stock exchange? We'll be able to fetch 120. So remember, when I exercise my right, I'm buying this thing for 110, and if I wish to sell it immediately, I'll be able to get a profit of 10 shillings. So that profit of 10 shillings, automatically, ladies and gentlemen, that is my what here? That is my fee. Listen and listen to me very well. Listen and listen to me very well. When it comes to binary options, when you want to get value over an option, what you do, you take the stock price, and then you subtract K, like that, right? And then ensure that it is always what here? Profitable. With options, you can never get a loss. So after 1 year, two interesting things are happening. After 1 year, ladies and gentlemen, I can see two things. I can see myself in this case, ladies and gentlemen, having stocks going for 120, Stock's going for 120, and here I am. I've been given a chance of buying a stock for 110. So the stock price is 120, the strike K is the strike price, or excess price, The excess price is 110. So 120 minus 110, this gives me what here, somebody? This gives me 10 like that. This gives me 10 like that. Now, how about this option here? If things don't work out, could you kindly tell me, in this case here, what is the CD? Kindly tell me here, what will be the CD? The call value, if we have a downward, minus 20, thank you so much. Minus 20, thank you so much. Thank you so much. Thank you so much. Minus 20. Is there anybody else who is seeing minus 20? Is anybody else who is saying minus 20? Dennis is saying 0. I don't know why, but he's saying 0. 0. Yes, Fidelis umepotea kidogo. Unajua kwa nini? I agree with you that I'm supposed to talk over what here the stock is 90 minus 110. Right? So 90 minus 110 gives me minus 20. But now remember, Fidelis, the definition of an option. Right? It is that financial instrument which gives you the right but not an obligation to do blah, 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 blah. If you realize you're going to make a 0, then you can never go for that option. The worst position of an option is to get a 0. When you realize you're getting to a loss area, always the value of the call will be 0. So the value of the call here will be what here, Evelyn? Will be 0. Evelyn, thank you very much for coming up at the very last minute. I hope you've been able to understand why we are saying here that the CD is 0. The CD is 0. If it's loss making, always you cap it at 0. You cut your losses at 0. Don't continue pursuing that objective. So I'm waiting to hear from from Evelyn. Evelyn, niambie kama ameona kwa tumesema 0. Kwa tumesema 0 and not minus 20, because options you will never make what here a loss. Evelyn ongea, Evelyn it's either unasema no, sija understand, ama yes. Evelyn ni jina kubwa. Great. Thank you so much. Sasa ukifika hapa, second last step actually. Second last step. Here, the examiner has not given us probabilities. So the second last step, come and calculate the probability of the upward. So calculate the upward probability. The upward probability. You calculate the upward probability. So how do we do that? Calculate the upward probability. How do we do that? So come and tell us here that the upward, the probability will be equal to 1 plus the risk-free rate of return minus the down all over the upward minus the down. Quite interesting, eh? Upward. This is upward probability. This one here, PU. This one here, PU, upward probability. It is 1 plus R minus down. Minus down. Millicent is saying hi to us. It's quite rare to get a student saying hi to Mwalimu and the colleagues. Millicent, hello. We are almost finishing this question. Someone has sent the question on WhatsApp. On WhatsApp is an illustration which is already on WhatsApp. So in this case here, the upward probability, you have to cram this formula. Is 1 plus R minus the down index. All over U minus the down index. So then what do we have, ladies and gentlemen? What we have here is this. My PU will be equal to 1 plus the risk-free rate. Are you able to remember the risk-free rate of return, you good students? You good students, are you able to remember the risk-free rate of return? Are you able to remember the risk-free rate of return? Are you able to remember the risk-free rate of return? 5%. 11, Jemime imetoka wapi? Fidelis 11 imetoka wapi? 5%. So 5% is the same as 0.05. minus the down index. Is there somebody who can remember the down index? Down index ilikuwa inakuja ngapi? Down index. Down index. Down index 1.2. Are you sure? Down. Down cannot be more than 100%, Naomi. Right? So in this case here, down is 0.9. All over the up which is 1.2 minus the down which is 0.9. So apenda pole pole mwendo wa kinyonga mpaka upate, thank you Naomi, at least you've seen your mistake, upate numerator, nipatie numerator figure. Numerator figure itakuja ikuwe ngapi? The numerator figure itakuja ikuwe ngapi oye? Numerator ya juu. 1.05 minus 0.9. Eric Odinga anasema ni 0.15. All over denominator. All over denominator. Denominator tunapata ngapi? Denominator. Akisa tumebaki na Eric Odinga peke yake. Tumebaki na Eric Odinga peke yake. Odinga jina lako ni kubwa sana. Are there times it has ever denied you some good chances somewhere? Odinga. Has it ever denied you or given you very big opportunity somewhere? 0.3. Unasema ni 0.3. Thank you so much. So 0.15 divided by 0.3, mnapata ngapi somebody? Mnapata ngapi somebody? The final answer 0.5. Thank you so much. This 0.5. So kumaanisha kwamba hapa probability ya up ni 0.5. Then what do you think in this case will be the probability of down? What do you think in this case will be the probability of down? What do you think will be the probability? Therefore, probability of down will be equal to 1 minus probability of up will be equal to 1 minus 0.5. So probability of down will be 0.5. Thank you so much. 0.5, yes. 0.5. Now, hata bila kujua chochote, wewe ukiona probability and numbers, what are you supposed to do when you see probabilities vis-a-vis numbers? What are you supposed to do? Probability vis-a-vis numbers, what are we supposed to do? Kiziona tu, you multiply it like that. So in short, give us the average. Give us the average or expected call value of a call. Value of a call option. Give us the expected. Expected means you multiply like that. So it will be 10 times 0.5 or 0 times 0.5. Ambayo inakuja inakuwa ngapi? Expected. Expected D inakuja inakuwa ngapi? Expected value of a call option. Wanasema answer ni 5. But now remember that this is coming after 1 year. This is coming after 1 year. This is coming after 1 year. Therefore, discount. This is coming after 1 year. Therefore, discount. Therefore, discount. So to get the current or present value of an option, come and take that 5, and because it's a one-off figure, discount it by multiplying it with the PVF. Discount it by multiplying it with the PVF. Discount it by multiplying it with the PVF. Meaning that this will be the same as 5 times 1.05 raised to minus 1. Hata ujaona nimetoa 1.05 wapi? Haujaona nimetoa wapi? Unaona kweli? Haujaona nimetoa wapi? 1 plus. Okay, it's risk free, but 1.05 is the same as what here? 1 plus R. Nakumbuka formula. Formula ya PVF. Formula ya PVF ni 1 plus R raised to negative N. Formula PVF, yes, and that R, you're right. That R is the same as what here? Risk free. That R is the same as risk free. That R is the same as risk free. So abracadabra, what figure are we getting here? Somebody abracadabra. Abracadabra, wanasema ati ni 4.76. In 4.76. Thank you and thank you so much. 4.76. Thank you and thank you so much. So this becomes the current value of an option using this very bogus model called binary. An examiner who doesn't like you, an examiner who wants you to fail, will give you this kind of a question. So the question is, has this concept ever been tested before? Is there any student who has ever seen this kind of a question anywhere in the past? Inakutest binary. Kunayo kweli ameshaiona? Mimi naona kama hakuna. Kama ameshaiona iko, Dennis amesema no. Dennis amesema kwa sababu kweli mwalimu hii mimi zai kuona kabisa. Kwa hivyo hakuna ama hivyo kwa syllabus. Aya. Watu wanasema bado hawajaiona kitu mbaya kama hiyo. This must be a bad thing, right? This must be a very bad thing which is never tested. Dennis anasema ameiona. Dennis alikuwa anasema no. Dennis alikuwa anasema no. So ni kama hakuna mtu ashaiona hii. Hii sasa hii ni kama angalieni May 2015. May 2015 question number 3C. May 2015 question number 3C. Imagine imekuja mara kadhaa. May 2015. May 2015 question number 3. May 2015. May 2015 question number 3. Are we there? Hata kwa umechelewa usijali. May 2015 question number 3. Are we there? Akiwa waniongeleshi. Sijui nataka kuongea na nani kama waniongeleshi. Oye. Niongelesha. Yes. Joseph, hebu piga picha, halafu weka kwa group. Thanks Stephen. Piga picha weka kwa group. Nikuambie mambo mzuri sasa. Your May 2015 question number 3C. Question number 3C. So all of us, do we have access to this question? I start reading it. Do we have access to this question so that I can start reading it? Baba Keo, good to see you around. And please be inquisitive like you have always been. Vocal. You have to be vocal. So at least I can see 3 students who have access to the question. Those are too few. What about the rest? So we are told there, see, our share is currently selling at shillings 120. There are 2 possible prices of the share after 1 year. Shillings 132 or shillings 105. Assume that the risk-free rate of return is 9% per year. They want us to give them the value of a 1-year European call option with an exercise price of shillings 125. What do you think of that question? Shared, thank you very much, Stephen. What do you think of this question? Don't you see that there is a similarity between this question and the one that we have just done? It's doable, eh? So I'm giving you 5 minutes to try. Let me give you only 5 minutes. We see whether there is anybody who will be able to do what here to just hack this question very easily. 5 minutes. So they've told us here something very nice. that a share is currently selling for 120. So the current price is 120. This is my SO. And then they are telling us something very nice here that there are two possibilities, hence the meaning of what here, binary. So two possibilities. So the two possibilities are like this. That we have got stock price upward. If things are okay, upward there. After 1 year, it will be worth 132. And then we have in this case here S down. So less than 120, down. It will be 105. And then they have given us the strike price. They have given us a strike price. They have given us a strike price. A strike price shall use to get the profits of the options. They've given me a stock price of what here, 125, a strike price or exit price of 125. So out of this, then I should be able to pull my CU and my CD. Very important. My CU and the profit basically. So the profit will be, I'm buying it at 125, selling it at 132. So it's this selling price minus the strike price. So we have here the CU, this one here will be 132 minus 125, which equals who? Somebody. Which equals who? Somebody here. Which equals who? Somebody. What is the CU? Somebody here. What is the CU? Somebody here. 7, eh? 7. And then we have the CD. The CD will be 105 minus the strike price is applicable to each of them, minus 120. But now the question is really, can we have a negative call value? Can we have a negative call value? If we realize we're getting a loss, we say no, and then we get a 0. So the 0 there becomes the call value like that. Now I know after this, the next thing will be for us to get, in this particular case, what here? To get. So now we have to get, we must get our probability. So how do we get our probability? So the probability here, ladies and gentlemen, here basically will be P, my P here will be equal to 1 plus R minus the down. All over U minus the down. Hii semester wanafunzi wote walishindwa kupata U na down. Hii index walishindwa U wakashindwa na down. We U ulifanya namna gani kupata U? Ulifanyaje kupata U oye? Ulichukua what divided by what kupata U? Please talk to me, please. Dennis amechukua pale 132 minus 120, so amepata the increase. But here you don't even have to get the increase itself. You can just talk of 132 over 120. 132 over 120, just like that. You take this, divide. I don't want that increase. I want your 1 point, I'm a 0 point directly. So 132 divided by 120 decimal places mzuri, ipatie itakuja ngapi? Yes. Yes. Itakuja ngapi? Patapotea 1.1. Thank you so much. How about the downward? Downward, I'm taking 105, this one here. 105 over 120 is general. So 105 over 120 is general. 105 over 120, this is general. Ambayo inakuja 0 point. What did you call Odinga? 0.875 like that. Yes. So then could you kindly give me the PU? I forgot something here. This is supposed to be PU, upward probability. Actually, the title here should be upward probability. Upward probability. So the upward probability, the upward probability, the upward probability, the upward probability, this one. So let me see whether there will be anybody will be able to get this upward probability. Upward probability. Great. Great. So remember, it is 1 plus R and the R is risk-free. So that will be 1 plus 0.09 minus the down, which is 0.875, all over the upward, which is 1.1 minus the down, 0.875. So you move slowly, part of the numerator. For the sake of the students who haven't yet gotten this, could you kindly give me the numerator value? Kindly give me the numerator value. 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 So numerator, naambiwa hapa ni 0.215 divided by the denominator. Denominator ambao naambiwa ni 0.225. Thank you so much. 225. So mara mwisho kabisa, what answer are we getting? 0.956. Thank you so much. 0.956. But now remember that this is my pool. What about my PD? PD now will be 1 minus 1 minus 0.956, which will end up giving us what figure? 1 minus 0.956, which will end up giving me 0.044. So this is what I'll come and put here. This is what I'll come and put here. This is what I will come and put here. This is so interesting. This is so interesting. This is so interesting because this is what I'll come and put here. My probability of upward, I'm being told it is 0.956. My probability of downward is 0.044. From there, I'll come and talk about expected call value. So the expected call value, you guys did tell me that Mwalimu work with an average. So take this times this. So now we have here 7 times 0.956 plus 0 times 0.044, like that. So could you kindly give me this expected call value? So according to Eric, it's supposed to be 7.69. And imagine Eric is the one who has been giving me 3 decimal places consistently. I don't know why he doesn't want to be consistent. And remember, uniformity in life is so important. Aha. So mnapata ngapi? 6.6, no worries, 6.692. Is there somebody who is able to get that? Someone else? Great, thank you so much. So if you kumbuka, this figure will be after 1 year. After 1 year. So then what do you think will be the last thing to be done? What do you think will be the last thing to be done? What do you think will be the last thing to be done? Discounting, isn't it? Discounting. So come and give us the present value. Thank you so much. So give us the present value, which will be that 6.692 times PV. Discount. So if I'm the one doing this, I'll write there discount, couple letters to scare my examiner. I don't know whether these examiners are ever scared, but I'll scare this examiner like crazy. I'll scare this examiner. Right? Yeah, I can see Baba K already has a discount factor. Yeah, thank you so much. So in this case here, and this will be 6 point, this will be 6.692 times 1.0. Remember, when you're discounting, you're always using the risk-free rate of return raised to this end of year one. So Babakeo gives us 6.136. 6.139. 6.139. But now you don't call this expected value. Now this has been discounted. It's current value. Current value. It's a current call option value. It's a current call option value. It's a current call option value. Now, we have got two methods of doing this. I've done this same question using a different method in the revision kit. In most cases, I find students not understanding this method. But for you, for one reason or the other, it's like you guys have really picked this very well. Or am I assessing you guys wrongly? It's like you guys are mean. You've resonated very well with this. What is your general take? Is this method understandable to all of us here, really? Have we been able to understand this method? This one is good. One more example. Show us the other one too. No, we don't want to waste time. If you've understood this, let's just stick with one. We don't want to waste time, really. If you have understood, or unless you haven't understood. The thing I could do is maybe to look at one more example, like that student is asking, but not a different method. We don't have that time. Great. Great. So one more example. There are very many. I'm surprised that you guys have never seen this kind of a question for exam. I'm surprised. There are very many. Come here, May 2014. May 2014, question number 1, dog. Perhaps I could leave you to do that as a homework. No, we shall do this one here. I know why. I know we shall do this one in class. May 2014, question number 4, dog. Inasema, a stock currently sells for 36. A stock currently sells for 36. A stock currently sells for 36. Okay. May 2014, question number 1D. Nimetuma kwa WhatsApp kama una. Kwa WhatsApp kama una, hebu ng'ang'ana nayo kidogo kuweza kuniambia sasa. So it is May 2014, question number 4, boy. A stock currently sells for 36. At least I'll start from there. The current price is 36. 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 So my SO here is 36. And then in the next 6 months, the stock price will either increase to 42. So if it is upward motion, it will be 42. S down will be 31. So come and give me the CU. Give me the C down. So of course, here I need the strike price. The strike price is 35. So then this will be 42 minus 35, which gives me how much? 42 minus 35 will give me how much? 7. Thank you so much. Of course, the other one will be what here will be 0. Will be 0, right? So of course, when they give you the upward price and downward price, you have to calculate the upward index itself. So the upward index will be 42 over 36. The downward will be 31 over 36. What figures do you have, somebody here? What figures do you have here? What figures do you have here? (42 over 36, 31 over 36. So the first one is 1.167, 3 decimal places. How about the downward? Downward 0.861. Thank you so much. Like that. And then we have our pool. So our pool, we have here 1 plus R. As this examiner given me the risk-free rate of 0. What here? 0.04. 0.04. But now remember, 0.04 is for a whole year, right? And as we are talking over how many months? 6 months. 6 over 12. Right? So in this case here, we have minus U. Our U is 0.861 all over 0.861 all over 62. Y 42 minus 36. 42 minus, is it 36? No, we don't get back to this. This one will only help us. This one will only help us in getting the upward index, downward index, nowhere else. Here, when it comes to getting profitability, we always use the strike price. So writing the strike price up here. We always use the strike price, which is 35. It is given there. Calculate the current market price of a call option on the above stock if its term to expiration in 6 months and its strike price is 35. 35. So all over U minus down. So 1.167 minus down of 0.861. So then the PU will be equal, who has this answer? Yeah. Great. We are almost there. We are almost there. They are almost there. So 0.52. Thank you very much. Then if this is PU, then P down will be 1 minus 0.52, which will be equal to what here, somebody? 1 minus 0.52, which will be equal to what, somebody here? 0.48. Thank you. 0.48. Thank you so much. 0.48. So now these are the probabilities that I would need to come and put here. Fortunately, by the time you are reaching here, utakuwa ushapata marks mingi sana. By the time unafika hapa, umekomboa marks karibu yote. So si lazima upate correct. AFM is not about getting correct answers. It's about the method, really. It's about the method. So then we have here 0.5 to the upward, probability upward, and then probability downward is 0.48. Therefore, expected call value, it will be 7 times 0.52 plus 0 times 0.48, which will end up giving me what figure, somebody there? 3.64, 3.64. So this one is 3.64. Is that okay for all of us? Is there anybody who used here 0.04 inside there? Is there anybody who used 0.04 inside there? We shall overcome. 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 Great. Thank you so much. So there we are. So come and give us the present value of call value. Call value. So it will be 3.64 times PV times PV, which will be 3.64 times 1.04 raised to negative 0.5, like that. Ambayo itakuja kuwa ngapi the last one? Final answer 3.64 times 1.04 raised to negative 0.5. Raised to negative 0.5. What are we getting there? 3.56. 3.56 or 3.57, like the one given in the revision kit. The one given in the revision kit. Time changes to 2. Baba Keo sija kupata hiyo swali. Ulizeni maswali jameni. Time changes to 2. Why 2? I haven't understood that question really. 3.57. Or half year. Oh yes, because of this 0.5. Because of 6 months over what year? 12. 6 over 12, yes. The rate in the PV changed. Hapana, wewe. Teri ni K. Angalia, katika PV yetu tunasema 1 plus R raised to n. When this n is number of years, then this rate must be rate per year. It must be rate per year. In most cases, we prefer this R being an annual figure, so that you can play around with this N. And that is why my N is not in terms of months, like 6. No, my N is 6 over 12, which is what year point? 5 over year. Unaona? Hiyo kitu niambia Terry, unataka kuniambia kama hapo ingekuwa 2 years, hapo ungechange ikuwe rate ya 2 years. Hiyo si kwa PV, ladies and gentlemen, hizi ndo za change. Kama ile mlikuwa mnafanya high school, nakumbuka high school tunasema the amount equals principal into 1 plus raised to n. Ukaambiwa kama ni semi-annual, divide this by 2, increase this by 2. Because you want to get the number of months or a number of semi-annual periods in a year. Kama ni monthly, divide this by 12, multiply this by 2 to get the exact number of months. But you see, we don't want to go that way. In this case here, these are for PV should be basically what year? An annual, right? Should be an annual figure. It refers to periods. Ukienda hivyo utapotea. Hii wewe ikue R ikue per annum. Alafu iko unapatiwa 3 months, sema divide by 12. Ikuje n in terms of what year? Years. Of course, you can work with months as well, but normally for the PV, we prefer PV to be done annually, like that. Great. Hata ukipotea huko mwisho, no worries, utakuwa ushapata vitu mingi sana. Utakuwa ushapata marks mingi sana. What you want this semester is to pass. So, ladies and gentlemen, that marks the end of our